Hello, everyone. We are going through very interesting times. Macroeconomic landscapes are changing world over. Central banks are gearing to raise up rates and curb inflation. And on the other hand, businesses continue to grow and thrive while they are coming out of the pandemic. Coming to today's agenda, we have with us Mr. Supreet Bhan and Christian Mariani from JP Morgan Asset Management to talk about the latest developments in the technology sector, why stocks have corrected, what lies ahead, and what are some of the interesting mega trends that are going in the technology sector. We will cover it all. So welcome you all, and welcome Supreet and Christine. And to take this forward, Supreet, over to you.
Thank you, Niranjan, and good afternoon, everybody. It's a pleasure to be joining this discussion this afternoon. I want to start by thanking our partners in India, Edelweiss Asset Management, for the opportunity to speak to you all at different occasions, particularly at a time that the equity markets, and more specifically, the growth cohort of US markets has been under particular stress. So it's always great to be speaking to you, but it is especially important to be speaking to you when the volatility that we've seen year to date is especially jarring for several of us. Thankfully, I'm joined by my colleague, Christian Mariani, who's the investment specialist for US equity that's based in Hong Kong, to help me synthesize a lot of this volatility and make sense of it, and almost like a North Star, guide us towards what does it mean for US technology, and particularly for the Edelweiss US Technology Fund of Fund that invests into the JP Morgan US Equity Fund. So if you could go to the presentation, I'm going to just start with a couple of key slides. I know I started out by saying that the volatility has been particularly jarring. This slide you may have seen before from our Guide to the Markets pack. This is essentially S&P 500, the bellwether index in the US. What we're showing you here is the past 42 years of calendar year returns in gray bars. The red dots that you see are the worst intra-year declines every single year. So the way to look at this is this year, S&P 500's lost about 13% when we did this analysis. At its worst point, was down about 5%. And in the past has indeed given up more. So for instance, I want you to cast your mind 2 years back, March of 2020. S&P 500 actually gave up 1/3 of its value in the middle of, or at the start of the pandemic at that point in time. Even though it had given up 1/3 of its value, it actually ended the year with 16% positive returns. You notice that every single year, S&P 500 or the US markets that it represents goes through different bouts of volatility. The scale of volatility differs, but every year you do see a drawdown anywhere between high single digits to somewhere around 20 to 25% as well. Now, granted, this is S&P 500. I would also acknowledge that the technology cohort has seen a more significant correction this year, and we will address that through the course of the conversation. But I always like to put this slide to contextualize that there are three certainties in the world: death, taxes, and volatility, particularly in a thematic fund which has seen a significant upsurge in the past few years. This also reminds us, just in line with what I said, that one of the certainties of life is volatility, that we're not seeing this for the first time. I also acknowledge, while we're living through it every time, it feels terrible. Just like 2 years back, while we were going through our lockdowns in Singapore, where I'm based, a circuit breaker, Christian in Hong Kong through its first level of lockdown, we all felt pretty miserable at that time. It was tough for us to imagine going through that lockdown because there were no vaccines, that the world would be a different place a couple of years down the line that Niranjan just alluded to. Similarly, we've gone through multiple events. It could be geopolitical events or a financial crisis at different points in time. What's important for us to remember is that while in the near term, there can be dislocations in the markets of the sorts that we're going through, over the medium to long term, the markets do focus on fundamentals, and that's what I want you to take as a central message as well. So for all these periods that are put in front of you, the average return has turned out to be anywhere between 21% to 37%, anywhere between 3 months to 12 months after that. It's not to say that this time is the same. History doesn't necessarily repeat itself, but it does rhyme to an extent. So I know I've just given you a little bit of a backdrop of the year till date, and particularly the last 4 to 5 or 6 months that has been tough on growth segment of the markets. Let me try and bring in my colleague Christian at this time to try and break down the year till date for us. Chris, over to you.
Yeah, great. Thanks, Supreet. From my side, let me just give you a little bit of help to navigate what's been going on a year-to-date, basis in the U.S. equity markets. And if you look on this slide, you can see on the left side the split of performance between style. So you see value, core, and growth, as well as the market caps, large cap, mid cap, and small caps. And the first thing you'll notice, this picture looks quite different from, say, last year, even more from, the previous year, where, last year we're seeing more balance between value and growth, at least in the large cap side of things. We started to see some underperformance of growth in mid and small cap, but this year, that's when really, the big kind of change we have seen in the US markets, with value really outperforming growth over the last few months. And as you can see, this is true across all the market cap spectrum. So whether it's that large cap, mid cap, or small cap, you can see how growth has been underperforming quite substantially compared to value. And I think that's the first important thing to highlight in the context of this fund. In technology, we are a growth investor. We are not looking to invest into very mature company typically. Cheap companies in tech typically mean companies which are losing market share, which are very mature. Their markets are not growing fast. And over time, this company might not be around. So if you think about technology, this same kind of picture applies as well, especially on the growth side of things. And if you take, say, NASDAQ as an example, we've seen about 30% correction in NASDAQ since its all-time high. Last time we've seen this was actually during COVID-19, at the beginning of the COVID-19 pandemic, in Q1 of 2020, when the market sold off and the NASDAQ has seen a 30% correction. So that's the first time since then that we see these type of movements in the tech space. On the right side, I think it's also important to kind of look at the sector level. What has been working is really things outside of tech. Energy, of course, that's on the back of what's going on in the Ukraine conflict and what that means for commodity prices and oil and gas. So as you've seen that spike in oil prices and gas prices, then energy companies have been benefiting from that. So you could say that that's really geopolitical driven more than anything else. And then finally, you see, it's quite interesting to see sectors like consumer staples and utilities, which of course are defensive sectors, but typically are seen as bond proxies. So during a rising rate cycle, they tend to underperform, but because of the the volatility we've seen in the market, we have seen these two sectors outperforming. And on the flip side, what you see is infotech, consumer discretionary, and communication services. I would put this kind of in the same bucket, because if you think about consumer discretionary, something like an Amazon would fall into that, which is basically like a technology company. And these are sectors which benefited strongly over the last 2 years in terms of performance, and they started to underperform right now, whereby what we are seeing is a market which, if you think about last year in the second half, there were, parts of technology which we've seen, we talk about the valuation were extended, software, parts of software. But what we've seen is the market is now pricing in effectively a recession scenario due to multiple issues, whether it's the geopolitical concerns, a massive spike in inflation, rising interest rates, tightening by the Fed, or China lockdown, putting pressure on supply chains as well. So, in summary, I'd say that we have seen many periods like this. These periods are characterized by extreme fear, and we wouldn't therefore rule out, over the next months or so, then as the volatility starts to, dampen down, to then see a more, I'd say a better environment for growth and in general also for technology after this type of correction.
It's an important point you mentioned, Christian. And while I said that one of the certainties of life is volatility, every time we see volatility, the sources of that volatility are quite different. So a couple of years back, it was COVID. Right now, it's largely to do with inflation and its ramification on interest rates. Why don't you spend the next few minutes synthesizing for us why inflation in the US is sticky and what does it mean for interest rates? And we'll take it from there.
Yeah, sure. So I'd say, like, first of all, like, more just taking like a kind of like a broader stance, not just inflation, but I'd say, the big question is really around, like, how is the Fed is going to manage through inflation and interest rates, and how does the Fed land the plane, so to speak, or the economy in this case. And there are three dynamics that I think the first one is, how well higher interest rates do their job. The second one, and I'm going to talk about now, is how inflation might decelerate going forward and why it has been so sticky. And then the last one, I think, is also how the labor market strains can cool down going forward. So if we zoom in on the inflation, now what you see here on this slide is the different components of inflation, basically just splitting inflation across different, parts of the economy, whether it's that energy, whether it's that goods related, like, vehicles, foods, and other parts like rents, which is shelter, for example. So the way we think about it is that there are some transitory element to inflation, which, if you think about energy before the Ukraine war, we would have expected that to subside going forward. And that meant that inflation would be coming down over the next few quarters. But as the war, in Ukraine, started earlier this year and is still ongoing, that put upward pressure on commodity prices. So that component of the inflation, for example, which, was supposed to be transitory, has not been as transitory as expected and actually contributed to higher inflation for longer. If you look at something like new and used vehicles, that's something which instead we started to see, inflation coming down there in the US, like prices for second-hand cars started to come down. So that's one example whereby you do see that, like, parts of inflation being transitory. While other, component that, for example, I think restaurant, hotels, and transportation, that's one which is less transitory in nature. And you might ask, why is that? If you think about over the last 2 years, most of the demand has been for goods, and that has been down to the lockdowns. People couldn't really travel, but now that the economy opened up, like at least in the US, parts of the developed world, as well as parts of Asia, what we are seeing is there is higher demand for services, including restaurants, hotels, and travels. So that means that that part of the inflation is likely going to be more sticky, given there is high demand for that. Now, the other thing I mentioned before is, like, how can inflation decelerate from here? And I'd say that, if you think about this, price pressure has been driven by a combination of super strong demand from one side and lacking supply on the other side. As financial conditions tighten from here, we've seen the Fed already starting to hike interest rates, and we've already seen how markets have been pricing that quite aggressively. We think, like, the good side of demand should start to moderate going forward. And at the same time, what you should see is supply should be improving. Companies have been adding back inventories across the board in the US over the last 2 quarters. Therefore, they've been building quite a decent cushion, even as lockdown in China disrupt supply chains. So we do think, like, we are a fundamentally better starting place compared to, say, during the peak of the pandemic, when consumers were not able to spend, for example, on services, and everything was directed towards goods. And then finally, I'd say that, like, the spike in energy, of course, is a risk, and that could be there for longer. But it's also worth to note 2 things. The first one is that as the oil price can spike high quite fast, it can also go down quite fast. And we've seen that in the past. So, for example, if we do see some, improvements in Ukraine, that would have a quite fast impact on oil prices, downwards, for example. and that will relieve some pressure of inflation. And the second one is that consumer in the US, they still have ample cash on hand from the pandemic era stimulus, which should help to navigate cost. So while we may need to kind of go through several more hot reports for inflation, like over the next couple of months, then we do think that the slower growth on the back of tighter financial condition and the normalization of COVID-19 driven inflation should then, bring this price pressure to begin to decelerate into the second half of this year and towards the year end, not to the 2% level likely that the Fed has always been talking about, more likely towards 3%, but that would be a clear signal for the Fed to perhaps not hike as aggressively going forward.
And just staying with that theme of interest rates, just walk us through our expectations of what FOMC's own projections are and what is the likely trajectory of interest rates, Christian?
Here I'd say that the market has been, if you think part of the volatility is really down to the Fed and what were the expectations. At some point there were even expectation of something like a 75 basis point hike, which hasn't happened and is kind of like, I'd say not going to happen, at least based on what we expect. We've seen a 50 basis point rate hike, which is the first one in decades. That we've seen for the reason I speak about before about inflation and try to cool down that part of the economy. Like if you look at the, what's priced right now by the markets is looking about 7 to 8 times hike for this year, going basically close to 3%, interest rate, like Fed funds rate by the end of the year. And I think we need to think about how well these higher interest rates can do their job, to really understand whether there can be more volatility or less volatility in the second half of this year. And I think much of the Fed rate hiking cycle has already been baked into markets. So we're talking about 30% decline in the NASDAQ. We're talking about the S&P, which is down quite substantially. Even value parts of the market has been down as well. And if you look, rates have been rising a lot, so much that some of the sectors are already feeling the pinch of that. So for instance, if you look at the US mortgage rates right now, the 30-year fixed mortgage rate is at the level which was last seen between 2003 and 2009, just to give you an idea, 5.5%. So we do think this will help to, slow down the economy. And that means that, as I mentioned before, together, if we do see inflation coming down, that means that, interest rates today are already tightening financial condition, even though the Fed is just a few hikes in. And that means that, later on this year, we might be in a scenario where the markets, already priced in too many rate hikes and the Fed need to slow down from there. And obviously that would be likely, good news for markets going forward. But as things stand right now, the market is expecting 7 to 8 rate hikes, going to around 3% Fed funds rate by the end of the year for the US. Partly linked to this, if I just a couple of comments is the labor market, because as you know, the Fed is looking not only at inflation, but also looking at the labor market in terms of looking how many hikes to eventually have during this year. And therefore, looking at unemployment rate, that is near a 5-decade low right now. And the fact that employers are having a hard time to filling job openings and wages are rising, these are dynamics to watch to understand what could be the path forward for the Fed. And we do think there are some evidence that, first of all, wage growth is starting to peak. And so far this year, what we've seen is that workers have been coming back into the labor force. So if this trend can continue, particularly as households spend down their savings from the pandemic, the net effect should be that also some of the strain that we've seen in the labor market should start to cool down, and perhaps wage inflation is not going to be as strong as anticipated previously. So all in, I'd say that we believe that the Fed policy is already having its intended effects, or removing the pressure and slowing things down. And that gives the central bank some leeway to undertake less hikes than the market is currently pricing in the back half of this year.
Let's spend a couple of minutes here because I think there's a lot of debate and conviction in amongst a group of investors that if interest rates are going up, there's a reason for growth stocks and particularly technology stocks that grow really fast for their valuations to compress. And there's merit in that, right? Because the future earnings, which are growing at a fast rate, if the discount rate is low, which is your interest rates, look that much more attractive today. And conversely, if your discount rate, which is interest rates, are going up as they are now, then the future earnings or the future profits look less there today because the discount rate has gone up. But at the very core of it, just stepping away from valuation expansion or contraction, we have gone through interest rate hikes in the past as well, even though the pace was different, which is you can see on this slide from 2015-16 all the way till 2019. There were about 11 or 12 rate hikes at that point in time. Understandably, inflation wasn't a concern as much as it is today. And the pace was a lot more modest compared to the pace that we're witnessing right now. But I would also argue that the biggest driver of stock prices over the long term are corporate fundamentals. And I'm going to bring you in, Christian, at this time to walk us through over the next couple of slides how are corporate fundamentals looking like in the context of technology? And I know that you have a slide to discuss how valuations have compressed in this period of time.
Yeah, absolutely. I mean, on the earnings side of things, like it's worth to note that despite the market is down quite substantially, earnings are expected to grow, this year and also next year. So if you just take the markets, as a S&P overall, like our expectation for growth actually being revised up slightly to 11%. You see 10% on these slides for this year, and next year we are expecting an 8% earnings growth. So we are in a context whereby, yes, interest rates are rising, but right now, like corporates are still increasing profits. Of course, not as fast as over the last year or so. That was also because of the low level, out from the 2019, from the pandemic. But at the same time, like for a developed market, like at pretty decent level of, let's say low double digit out there. There is some, as you can see on the right side, divergence between sectors. You can still see, of course, places like industrials and energy growing faster, for the reason we talked about before in terms of what's going on with commodity prices. But at the same time, technology, for large cap technology, we're still expecting around 12% for this year. If you think about our portfolio, the expected growth rate that we have right now is around 19%. So clearly we've been gravitating actually towards large cap, but our growth rates is well above what's the large cap tech universe, at least in the S&P 500, for us. So first of all, in terms of earnings growth, once again, we are not pricing in any kind of recessionary type of scenario whereby the overall earnings growth are declining here. Earnings growth are actually still growing. And secondly, I'd say also quite important is to look at what's the state of companies' balance sheets. And that's what you can see on the next slide. And first of all, if you look on the left side, if you look at how much cash companies have as a percentage of current assets in the US, is still at very kind of elevated level, at least historically. So as you can see, that's more than 30% of current assets are sitting in cash. And that's supportive, especially at the time where you could see slowing growth, globally, generally. So that's definitely a sign of strength in terms of the company's balance sheets. And the other one is, I think, I'll point towards the bottom right chart, which is looking at the interest coverage ratio. And of course, rising rates, that means if you have kind of flexible interest rates, that will push your financing cost higher, your interest cost higher, or for companies as well, which are taking on new debt. But as you can see, what you see is that the latest reading is still very positive, meaning the higher that line it is, the better, or the easier for companies to cover the interest rates, interest expenses with their earnings effectively. So we are not, in a situation whereby companies are not able to cope with higher interest rates from a balance sheet perspective. And at the same time, we are in a situation where, corporate profits are still growing going forward. And that means that if you think about these two things, and especially the earnings, if the market is currently like down substantially year to date, the overall valuation has been improving quite substantially. And I'm not talking about all the technology, but even if you look at S&P 500, for example, now the S&P 500 price earnings forward is basically in line with what used to be the last 15 years average, effectively, down from, say, 22, 21 times to close to 16 times to 17 times, for example.
And that serves as a segue to what's been a tough year so far for the strategy as well. So why don't we walk through over the next couple of slides what's caused that pain, and just try and synthesize what's been the detractor in the performance, both in absolute terms and in relative terms as well.
Yeah, maybe if you just quickly go one slide back, I want to just point out, like we talk about valuations, and I just want to show like the software as a service like valuation, what we've seen on the next slide. This one. What you see is that over the last few years, we've seen this expansion in valuation for software as a service companies, especially in the highest growth cohorts. But what we've seen, I talked about like briefly before that last year in the second half, we talked about how parts of tech, especially in software as a service, were extended in terms of valuation. And if you see, the valuation in that part of the market have been coming down substantially, so far this year. The latest reading, which is not on this slide is as of March. If you look at end of April, basically the valuation are in line with the middle line, the blue line that you see. So the average over the last more than like effectively 10 years there. So we've seen like the market, as I mentioned, pricing in a much tougher environment for some of these companies, whether it's that for interest rates rising, whether it's that for geopolitical crisis, slowing macro, and generally pricing in a recessionary kind of like environment. And that has been reflecting overall, not only in software, which is down substantially, but also in other parts of like of tech, whether it's that e-commerce being one of them, or some other high growth names, especially companies which they're not necessarily making a lot of free cash flow right now. They're still relatively early, let's say, in terms of like their life stage. So if you go on the next slide, where you were showing the, the attribution, for example, if you look on the detractor side, Roblox, that's a company which became public only in the middle of last year. That's one example of these companies which have been underperforming substantially in the current environment. Affirm Holdings, that's a company which we sold earlier this year, but that's another example of quite a young company in a fast high growth market in buy now, pay later, linked to e-commerce, which has been suffering. These names are down 50, 60%. And if you look from their all-time high, some of these names are down 70% or more even. Just a few other examples, if you take Shopify, that's a large cap company, was down 75% over the last 6 months. If you take something like a Zoom, which was, of course, one of the best performing stocks during COVID-19, that's also down around the same over the, since their all-time high, for example. So we've seen like, definitely quite big compression in some like high growth, like high multiple companies, perhaps like, companies at the earlier stage of their life. By the same time, also, if you look in the detractors, something like in advanced micro devices or Lam Research, these are instead well-established companies, which are, very profitable right now. They are down around 25%, as you can see here to date. And that kind of gives you the idea of like the difference between how much like a well-established company with positive free cash flow is down compared to something like which is high growth and a high multiple in nature. Overall, I'd say for our portfolio, if you've been in some of these calls over the last few quarters, we talk about how we try to reduce exposure to some of the more expensive parts of tech. Of course, we still have some exposure there because we are a growth fund. So something like Roblox or Affirm Holdings, these are some example of those names. But over the last several quarters, we've been increasing exposure to other semiconductor companies first in the last 1.5 years, and also in general large cap companies, which in this environment they can do better. They can cope with that volatility better in terms of like they already have a high free cash flow. They have a lot of cash, and then they could navigate the current environment in a better way. But overall, once again, we are a growth fund. We want to invest in some of these like smaller companies, which can give us, let's say, the next Amazon, the next Facebook over time. So having some of that exposure hurt during the current environment.
I think I'm going to use that as a segue to go into performance, and maybe just use that then to speak about what the current positioning is. We've all been discussing some of the challenges that specifically the technology cohort in the US has faced. This shows you the year-to-date performance in the top half as of 30th of April. The fund's down more than 25%, so at about 27.6%. Over the last 1 year, it's down about 21%. And these are US dollar returns, not rupee returns. But if you were to cast your eyes towards the right-hand side of this slide, which focuses on 3-year compounded annualized return at 18%, 5-year at about 23%, and 10 years at about 17.8%. Now, these are extremely encouraging numbers for long-term investors. It's not to take away the pain that the short term is bringing to investors, but it's really to focus back on the fundamentals which prevail over the long term, despite a lot of the news bites that are there today. You notice in the bottom half through the calendar years over the last 10 years as well, the fund's gone through different periods. But the one thing to note is in most periods, it's outperformed its benchmark as well. So even though there's short-term pain, do want to emphasize that over the long term, whether it's 3-year, 5-year, or even longer, the fund has delivered very competitive and strong total returns to clients. Chris, why don't I then very quickly go back to the current positioning, and why don't you walk us through how we are positioned, having spoken about what the challenges have been and what the prospects are, and I'll come to what the underlying fund does in just a moment.
I'd say I mentioned, about this like before on the detractors. For example, we've been, reducing exposure to some of these high growth, high multiple companies, which could find it challenging in the current environment. So you can see, for example, on the bottom, Affirm in blue, that means like we eliminated that stock, and similarly other like smaller cap names like Lemonade, like Global E. These are all companies which are, not profitable right now. They are high growth in terms of their revenue, but they have, negative earnings and like negative cash flows right now. And similarly also for Coinbase. Now, I'd say these are really interesting companies, but perhaps like they're not the right one for the current environment. So we are trying to find ways to protect the portfolio as much as we can in terms of like eliminating what, companies which could find it more challenging right now. At the same time, we eliminated like early this year, like in early February, PayPal, for example, which has seen like more challenging like markets in general, like in terms of like competition from other players in the electronic payments market. So that's a company which we eliminated early on. And then I'd say that, another thing to highlight is, as you know, we had this large overweight to semiconductors for quite some time and a large underweight to software. We are slowly kind of adjusting these to balance these more out. Of course, you can't clearly see that if you just look at this, like chart here, because semiconductors are still the largest overweight. But if you compare to say where we were the end of last year and where we are now, end of April, semiconductor overweight has been starting to come down, and the software underweight also starting to come down in terms of like starting to get towards a more neutral type of like position. Why is that? For two reasons. First, on the semiconductor side, of course, we had two pretty positive year for semiconductors. And we do think there are more risks coming on those parts of like tech, in terms of like being more kind of like at the peak of the cycle for parts of semiconductors. Just to give an example, if you think about the demand for personal computers we had over the last 2 years, that's not likely to be there over the next 2 years, for example. So we have been eliminating, for example, the more cyclical parts, cyclical names like microchip. That's one name which we eliminated, and we started to reduce exposure to some of the largest weight we had in semiconductor, like in AMD, advanced micro devices, which is still in the top 10, but it's not as big as it used to be, for example. So definitely, I'd say looking forward, likely the semiconductor overweight will continue to, come down. And at the same time, in software, as we talk about, like some of the stocks are down substantially. Valuation have been coming down to the point that they're now below what used to be the pre-pandemic kind of level in terms of valuation for software companies. So we want to find more opportunity there. I'd say not necessarily just the most expensive names. We've been trying to find companies which have reasonable valuation. They have already a lot of free cash flow. And therefore can perform better in this type of market environment. So, you can see Oracle being a good example of that. It's one of these names, is a database management company in the software space, has been a slow grower over the past decade because of the shift to the cloud, where they have been slow to move their capabilities to support applications and infrastructure. But if you think about Oracle's software support most of the critical function for a large share of global large enterprises. And we think they have an opportunity to begin moving the customer to a more modern architecture. So if you look at Oracle, their cloud business is now expected to grow higher than what the expectation were. And we think they can then kind of move towards what Amazon or Microsoft or Google offering is over the next few years. So that's one example whereby we see an opportunity for a longer duration of revenue earnings growth. The company is not as expensive as, say, some of the highest growth software as a service name, and they have a very high free cash flow. So if you look last year, they had $14 billion in free cash flow, for example. So that's one name which we think can benefit. VMware is similar kind of story in the software side of things. And then, I'd say other names which we've been adding over the last few months are something like a Booking.com, which can still, benefit from an increase on spending towards travels, hotels, as the world kind of open up like after COVID-19. So to summarize, I'd say, from one side, we started to reduce semiconductors exposure. The more cyclical ones, we reduce names which are very expensive, and at the same time they have negative earnings right now, even though they might be interesting over the long term. We think it'd be challenged in this type of environment. And on the flip side, we started to increase software exposure and generally trying to find names with more reasonable valuations, but still the opportunity to grow faster than expectations. Now, you can see here some of the, on the left side, the type of names that we currently have on the top 10. These are mostly well-established names, as you can see. They are well-profitable companies, typically, in most cases. And, these are some of the names that, we favor now, for example, like Salesforce, which wasn't there in the top 10, is now in the top 10. If you look end of April, it's grow even bigger than that, for example. That's one other example in software, which we've been adding, for instance. On the flip side, you notice how AMD, the weight starting to come down. As I mentioned before, Tesla, that's another name which we've been trimming on strength. In general, Tesla has done better than the average kind of like growth company out there, and we started to trim some exposure there. And we still have a lot of exposure into kind of mega cap tech names, which, in this current environment, definitely can hold up better compared to some of the other names we talked about before.
I think it's important to just emphasize the characteristics of the portfolio. As of 31st of March, I apologize, this is not as of end of April, slightly dated. So the numbers would have moved, particularly because the technology stocks have corrected significantly in recent month. But
actually,
if you look at
I can actually like quote the April number just to give you an idea, especially on price earnings. The portfolio is trading at 22 times, down from 25.9. And that compares to our benchmark, is trading at 16 times. So if you think about that gap, like in terms of premium, has been coming down quite substantially for us versus the benchmark. But yet, if you look at the EPS growth, for instance, we're still calling for 18% end of April, that compared to the benchmark at 14%, for example. And finally, the last one I would just want to highlight is the return on equity of the portfolio being much higher compared to the benchmark. And that's still the case also for end of April. So sorry if I interrupt you, but I just wanted to highlight these more updated numbers, especially on the multiple side of things.
I'm glad that you did, because Christian, for me, I've been tracking this fund for several years, and I think the P multiple that you've spoken about is the cheapest that I've heard since I've been tracking it over the last several years as well.
Yeah, definitely.
I'm going to just go ahead.
Yeah, I was saying definitely. And it's if you think about the pre-pandemic levels we were at, it was above 15 times back then. So we are now well below that, and close to basically 20 times for the portfolio.
Okay. I'm going to spend a couple of minutes on the long-term story. We focused a lot on the near-term concerns, the sources of volatility, and the reason why de-rating's taken place. But at the very core of it, let's focus on the long-term investment thesis. And I'm just going to look at a couple of more slides and then pass it over to Niranjan to invite your questions. And I certainly hope that we have time to address most of them, if not all. I know many of you are familiar with the strategy, but just as a reminder, our fund essentially focuses on beneficiaries of mega trends in technology, particularly around themes such as cloud computing, digital transformation, the fact that many of us have transitioned our business not just on mainframe, as was the case over the last couple of decades, but indeed on cloud, the fact that there is flexible work from home or work from office arrangement, and artificial intelligence, which is likely to be the driver of demand for advanced computing, quantum computing going forward, requiring even faster and more superior semiconductors and other technology systems going forward. Many of us are familiar with autonomous cars and machines, really at the start of a long-term trend where the addressable market for autonomous vehicles is not just the cars that are being sold today, but potentially all the vehicles on the road. Electronic payments, India is very familiar with it, but even over-the-top streaming, and for that matter, digital advertising, where consumers are now consuming advertisement not through hoardings or traditional print or television media, but through digital advertising. It'll be interesting to see how metaverse really transforms the way we consume information, just like maybe about 25, 30 years or 25 years back, most of us, at least I, could not fathom the impact that internet would have had. If you would have asked me in the 90s when we had dial-up connections into internet, if you remember what those were, and if you would have told us that most of our requirements as consumers we'll be able to fulfill through the internet, I would have found that to be a fantasy. And clearly today, that's a reality. Similarly, the potential that metaverse might have for the future is really something that we're quite interested in through, again, capturing through many of these opportunities. I'm just going to use one final slide. This is really focusing on the principles of successful long-term investing. Now, we all know there is this desire to avoid drawdowns or correction in the market and really to try and time the markets. This is an analysis that you can see on your screen, which has been done over the past 20 years of the markets, essentially saying that if you would have just invested $10,000 in S&P 500 and not worried about market timing and stayed through the highs and the lows, and remember, you've gone through a global financial crisis, you went through multiple episodes, including the recent correction, even then, an investor, which is represented by this first bar graph on the left-hand side, would have made close to about 7% return in US dollar terms. But those who do get perturbed by volatility and try and time the markets, and in the process of timing the markets, let's acknowledge we will miss some of the best days. misses 10 best days in the market, the return actually halves to about 3.5%. The important thing to remember is given to you in the box over there, which is that while most of us find this level of volatility quite jarring, the reality is that 7 of the best 10 days have occurred within 2 weeks of the 10 worst days. Now, I do acknowledge living through those 10 worst days is really horrifying for all of us, but that's how the markets are. 6 of the 7 best days in the markets occurred after the worst days, the very next day. The second worst day of 2020 was just 2 years back, March 12th, was immediately followed by the second best day of the year, which really highlights the need for long-term investing. And I know many of you are familiar with this concept. It's the time in the market, not the market timing, that matters. I want to thank you for your patience listening to our presentation. Hopefully, through the course of our presentation, we've been able to address some of the factors that have led to recent volatility, but bring your attention really to the long-term drivers of performance of strategies, such as US Technology Fund. And we do look forward to your questions. And at this point, I'll pass it over to Niranjan.
Hi, Supreet, and thanks, Christian and Supreet, for taking us through very, very important statistics and the current portfolio positioning. I think we have been able to answer a lot of questions which we have already had, but there are a couple of questions where we can throw some light. The first question is, it's been almost 8-9 months of drawdowns in the strategy. While it's quite difficult to perfectly time when the bottom would be, but what is the sense till what time the markets may remain volatile? And looking at the past, when interest rates rise, while we believe that a longer period of time, or at least in the medium term, the returns are good, but what was that period where markets remain volatile during this cycle? And what could be true for technology as a theme? Because a lot of investors have completed maybe around 1.5 to 2 years. Of course, the strategy is for 5 years, but they have this question, till what time the pain may remain.
Yeah, I take the question, and yeah, maybe I'll start just saying that, going in terms of like what Supreet mentioned, market time is quite difficult. So I think giving a precise indication of when the bottom could be is hard. I think it's dependent on a couple of things though. First one, on the macro front. And as we've seen, parts of volatility is down to macro and what's happening in terms of the inflation or the interest rates in the US. So, what I mentioned at the beginning in terms of how can the Fed land the plane or land the economy, it's revolving around a couple of things, whether higher interest rates are able to do the job in terms of cooling down some of the, parts of the economy. And also inflation, whether it can decelerate going forward. But, once again, our base case is that if you do see tightening financial condition, which we are seeing, that will, effectively slow down some of the strong demand for goods we have seen. And at the same time, you're seeing improving supply chain side of things. So to some extent, if the inflation comes down going forward, then I think there is an upside case to make in terms of maybe we are going to have less rate hikes than what's currently priced into the markets first, together with what's going on in the labor market, as I mentioned. Second, there is something that is tech related in terms of looking at the, the prospects for the companies. And in general, I think a lot will come down to software, in terms of having kind of a better setup into next year. And for that to happen is, I think, something that needs to happen is that some of the companies need to acknowledge, the sign of macro weakness and the risk to their pipeline, meaning some of the, estimates might be revised down in the second half of this year. And that, will be kind of putting a bottom in some of these names. But as I mentioned, the market is always forward looking and, already kind of priced in a lot of the slowdown that we've seen in some of these names. As I mentioned, Shopify is down 70 to 75%. For example, Zoom is down similarly. If you take in software space, Okta is down 70% over the last 6 months and so on. There are a lot of these examples. So in a sense, like I'd say we are closer to the to the end of the tunnel rather than at the beginning of it in terms of like where the bottom could be, even though we can't point out exactly when.
Thanks, Christian. The second question is, how are the earning numbers for some of the major internet companies coming up? While the underlying earnings growth could have multiple headwinds and tailwinds, also if you can throw light on how are the top lines, which will tell how is the demand situation with interest rates going up and the macro backdrop changing all over the world and even in US.
Yeah, I'd say that if you look at the e-commerce companies, e-commerce is one of those places which has seen, starting to see some of the signs of, say, a slowing macro. And of course, that means like a slowing demand for some of the goods. So definitely you do see some of that. And you've seen, for example, some of the advertising names which underperform because of that, because of course, companies will be willing to spend less in terms of advertising on some of that. However, I'd say that if you take, companies like, let's say Amazon, for example, right? Clearly they have like a large part of their business, which is e-commerce related. But on the other hand, if you look, for instance, what's the driver of growth is really the cloud part of the business. So we don't have like many, let's say, pure play e-commerce company in the portfolio, as a matter of fact. Most of them tends to be diversified. Amazon is kind of like a good example of that, where we like it more because of, AWS and Amazon Cloud rather than like the e-commerce side of things. But it's true that you do see a slowdown in e-commerce like names, and Shopify is also another company which, part of the reason it's down 75% is because it's one of the major like e-commerce related like software names out there. So that's something that is true. Like, we do recognize that there is kind of like a softer kind of like environment for some of the e-commerce names. But at the same time, some of these companies that's balanced out by the exposure to the cloud, for example. I mean, maybe just like to tie on that one, cloud migration is we think one of the best places in terms of like the demand is still there. And you can see that happening even in the current environment as well. So a lot of the names in that space which they actually reported very good numbers. So something like a MongoDB in software is one example, like Snowflake is another one which reported like strong numbers. So you do see this kind of divergence, I'd say, whereby some same-ish names are starting to have a little bit more weaker kind of trends down to supply chain, and some peak, let's say, demand in parts like PCs and laptops. You see parts of the e-commerce which are struggling. Definitely, as I mentioned, advertising companies is one of them. And then on the other hand, you're starting to see improving trends like in other places like software or like clouds, like type of names, for example.
I would only add, Niranjan, that ultimately this is an actively managed fund, right? And exactly to Christian's point, this strategy has the ability to identify the winners and stay away from some that are challenged. Ultimately, what we're focusing on are long-term beneficiaries of these structural trends. And if those companies get challenged because of some environment, like Christian pointed out through the course of the portfolio positioning, the strategy has the ability to lighten its position accordingly and change as per the prospects and the fundamental prospects of those companies going forward.
So I think we are running out of time. I have last question, and pretty important question. If you see that there are some or the other proxy tech indices like NASDAQ, I believe it is not a pure tech play, but it does have some component to technology. And these broad-based indices have particularly done well in the recent fall. So what is the reason for that? And how this fund is currently positioned vis-a-vis these indices?
I think it's a great question, and one that we prepared for. The reason that you're seeing this slide, and first of all, let me try and explain this line graph to you. This is essentially showing you 3-year rolling returns of our strategy in dark blue, the NASDAQ 100 index in orange, and the S&P 500 in blue. The reason we're showing you 3-year rolling returns is, first of all, assuming that most of us on the call here are long-term investors. Secondly, rolling return takes away the bias of point-to-point returns. What do I mean by point-to-point? The fact that technology is going through a particularly tough time year till date. If you were to do a 1-year comparison, clearly that's building in a big bias of this recent correction. But if you have a 3-year rolling return, it gives you a broad sense of how the strategy is done relative to the benchmarks. Now, I'll ask you to cast your eyes on this slide. You notice that for a big majority of the time, barring the recent one, which is when the blue line slipped below the orange line, the 3-year rolling returns of this strategy have been significantly superior to the S&P 500, which is a broader benchmark, as you rightly mentioned, Niranjan. But even the closest broad benchmark, which is deemed to be technology heavy, which is NASDAQ, it's outperformed on a 3-year rolling basis consistently, again, barring the recent times. I mentioned a term very recently, dislocations, and I think the recent correction is largely a reflection of that. What's also worth mentioning is that many of these structural winners and beneficiaries of megatrends could be smaller companies currently and may not be a part of the index. And we've seen several examples in our portfolio, which we've held very early on in its evolution. And it's become a part of NASDAQ much later on, once that stock has become a large cap or a giant cap. So it really depends, Niranjan, on what the client or the investor is looking to achieve. If it's a broad-based approach to US markets, clearly a broad-based strategy is more relevant. But if the idea is to identify the long-term winners from these structural technology trends, which are not impeded by these cyclical issues, then clearly a strategy like US Technology Fund, which has a long-term track record of outperforming benchmarks, including its own, as well as the indices that we put on in front of your screen, are really strategies that serve that purpose. Of course, it goes through times like the ones that we're going through right now, where some of those other strategies look more promising.
Thank you so much, Supreet. I think so we have tried to answer as many questions we've got today, and a great presentation. Thank you, Christine, for taking us through all the contours of this theme and how the fund is positioned. I think so this will give a lot of comfort to all our investors and help them take a very informed decision, in fact. So thank you so much. Have a great week ahead. And thank you all for participating today. I hope this was useful for you, and we'll see you soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.